Welcome, everyone, and thank you for joining us. My name is Molly Blau-Gillis, and I'm Chief Communications Officer at General Catalyst. We're so glad you're here for the kickoff of our Conversation Catalyst Speaker Series. GC created the series to feature unique perspectives, insight, and leadership from GC, our portfolio, our community, and beyond, focused on topics that are core to our mission of investing in powerful, positive change that endures, including responsible innovation, health assurance, and economic access, to name a few. In today's conversation, GC Managing Partner Hemant Taneja and New York Times finance reporter Maureen Farrell will discuss the future of venture, capital, culture, and company building. Our Conversation Catalyst series will continue on Monday, February 28th, with a panel discussion focused on the promise of health assurance, making quality care more affordable and accessible to all. More info and registration can be found in the chat, on the GC Amplified section of our website, and on our social channels. A couple of quick housekeeping items. As a reminder, this session is being recorded. Closed captioning, as well as a live transcript, are available for anyone who is interested. If anything should happen with the Zoom session, please immediately log back into the meeting and we'll proceed. And now it's my great pleasure to introduce Hemant Taneja and Maureen Farrell. While you may know them as a prolific investor and distinguished reporter, respectively, they're also both published authors. Let's start with Hemant Taneja, our firm's managing partner. He is an early investor in market-leading companies, including Stripe, Livongo, Samsara, Snap, and Gusto, to name a few. He's also the author of Unscaled, on Healthcare, and soon to be published next week, Intended Consequences: How to Build Market-Leading Companies with Responsible Innovation. In his latest book, Hemant lays out an actionable framework for founders and executives on how to build innovative companies for growth and for societal good with fewer unintended consequences and increased inclusivity. Maureen Farrell is a New York Times finance reporter and author of The Cult of WeWork, Adam Newman, and The Great Startup Delusion. Prior to joining the New York Times, Maureen spent nearly 10 years at the Wall Street Journal, where she covered the public and private markets, as well as WeWork and other startups. Now, is there anything better than a good book? Everyone attending today's discussion will receive a free copy of Hemant's book. You'll have a link in the chat to reserve your copy, and there's a link in the chat to purchase a copy of Maureen's book as well. Enjoy. And now, without further ado, please join me in welcoming Hemant and Maureen. Maureen, I'm handing it over to you.
Wonderful. Thank you so much, Molly. And thank you, Hemant, and the whole team at General Catalyst for putting this all together. I'm incredibly excited about this conversation. Hemant, we've gotten to know each other over the years. It's been wonderful to kind of follow some of the companies from a relatively early stage when you've been in till these sort of blockbuster companies we're seeing now. Excited to have a chance to kind of unpack how you're thinking about them, what you're seeing in the future. So I guess just to get started, you've written 2 books. One will be coming out very soon, Unscaled, on Healthcare, Not Unintended Consequences, Intended Consequences is the title of this book. In a lot of them, you put forth some projections and predictions. Love to talk to you. Let's just start out by talking about what surprises you most in terms of what you foresaw and what actually came to pass.
Yeah, first of all, it's great to be doing this. It's great to see you. Look, these books have generally been our attempt to organize and share our own learnings, and so much is changing in tech that is forcing us to be a lot more intentional. So when we wrote Unscaled, it was based on the observation that 20 years ago when I got in the business, we were investing in software companies that were essentially providing some level of efficiency to our major markets, major parts of the economy, healthcare, finance, education, and whatnot. And this last decade, we started actually going from an efficiency vendor to starting to put together new banks and new schools and new healthcare service companies, all largely on the internet. And so it sort of forced us to think, well, why is that working? And the observation there was, because we have started to create a lot of these platforms that are organizing content, community care, commerce on the internet, scale was not going to be a moat anymore. And so the mass production advantage of bigger companies in every category got, started to lose out to the mass personalization advantage, where emerging companies could build the very best products for exactly what people wanted versus something that was good enough and cheap enough for everybody, right? And with that it comes a lot of responsibility, because tech all of a sudden is frankly responsible for the digital transformation of society. So we said, boy, first of all, it's going to take 30 years to do this. This is not a 10-year cycle like we're used to seeing in venture. So I think one of the things I had written about in Unscaled World, this is not stopping. And the other thing was that we did have to be a lot more careful about how we apply AI and do a lot of these things, because internet caused the digital divide, and CRISPR could cause the biological divide if we're not careful. And so that sort of leaving certain stakeholders in society behind could be a issue. So that book forced us to start to take a look at each of the sectors much more intentionally. And as you know, I dove into healthcare in part because Livongo was starting to show success. This is like 2016, 17, 18. And we're like, oh boy, we can actually build a healthcare company that has the NPS of Apple and is truly dedicated to reducing the cost of healthcare and keeping people proactively healthy. And it's like, well, if that is now doable, what does the transformation of the sector look like? So for the first time, we started to say, let's think about it at a sector level and say, let's re-architect the healthcare ecosystem against our principles of health assurance. Keep people proactively healthy, reduce the cost of healthcare, and address it for all stakeholders. We thought that was going to be over the next decade, the biggest opportunity. And we actually wrote an internal plan when we were writing on healthcare that will make this a core focus. 20% of what we do will be in healthcare. And obviously with the pandemic, so much of what was written in those two books got accelerated, right? I mean, healthcare, everything we put in our business plan of doing over the decade, I think we're going to end up doing in 3 years. So healthcare got accelerated, but as you know, commerce got accelerated. Technology essentially helped us get through the pandemic in many, many levels. So you could see the glimpse of what it could do, accelerated adoption. It also showed us a lot of problems. The other issue that we were concerned about, which is around, well, if we don't build these companies with great intentionality, we'll create stakeholder challenges. Well, that also happened, right? With if you think about all the issues around our democracy, all the issues around our polarization. So that's sort of reflecting on those things is what led to writing this book, to say, how about now that we think about the transformation of the rest of the sectors, we bring some intentionality to it in how we approach it.
So it's interesting. I mean, it's both in one way, things accelerated so much more quickly than you thought. I mean, particularly healthcare, telemedicine. I mean, we've seen that, and in other areas. And then it's almost like the velocity of the unintended consequences has happened, with the scale and everything else very quickly. So I want to get more into each piece of that, but I guess while we're just starting out, let's talk about predictions first. I mean, we're at the beginning of this year. Well, I mean, it's been a kind of a wild year in the markets and just in general already. We're only a couple of weeks in. I'd love to just start with a couple of areas of predictions. Number one, the broader VC world right now. And I'll just say from what I've seen over the last year plus, I mean, it was, we can go back to 2017 or so, and SoftBank raised the Vision Fund, and it was the largest fund ever, a tech fund never before seen. Bit by bit, I mean, you're seeing firms all over raising the largest funds ever. Everything's just getting bigger and bigger, including, I mean, there's some news out there that General Catalyst is raising bigger funds, more of them. What do you see happening right now in the broader VC world? Where's it going?
Yeah. So look, first of all, if technology is as significant a driver in the digital transformation of society as a whole, then we know a lot of returns are going to accrete to this asset class, right? And obviously, empirically, when you look at what happened in the last couple of years, I mean, so many companies have created between 10 and $100 billion of value, right? So when you see the scope of what technology can deliver, it's making this industry grow up. It's growing up from being this cottage artisanal industry where, you were a rock star if a couple times in your career you could invest in an early stage company that got to 100 million in revenue and $1 billion IPO. And now, you're seeing companies that are, 100x, 1000x bigger. So like a trillion is a new billion, right? So I think what's started to happen is this institutionalization of our industry is happening. Many firms, including us, are saying, what is the best way to support the founders? If the outcomes are this much bigger, obviously that requires more capital, different governance, and obviously other asset classes, public market investors, hedge funds, they're all also saying, wow, there's so much return in the what was traditionally early stage venture capital asset class. Why don't we come down to SAC and invest earlier? So the early funds are becoming platforms, larger funds are coming down early, and what you're seeing is, creation of uh, uh, a handful of full stack platforms that they have their own approaches, but frankly fundamentally focused towards saying how do we maximize opportunity now that the outcomes are so much bigger. So I think that's the mega trend that I think is happening. Obviously, when you think about, well, how do you innovate a business like ours to play that trend? You can create funds around different sectors. Some firms are doing that. You can just raise more capital, make your funds bigger. Lots of firms are doing that. You can, invest in other geographies as well, and some firms are doing that. So I think there's a lot of that happening because everybody's trying to differentiate the ultimate commodity called money. I do believe this industry, sort of 10 years out, looks to be much more consolidated across a set of platforms.
And tell me a little bit more about how you're thinking about that at General Catalyst. I mean, you obviously have a tremendous track record, and that, that sells, I'm sure, your capital to entrepreneurs. But when there's so much, when entrepreneurs are getting kind of inundated with offers of money and bigger valuations, how do you differentiate yourselves?
Look, I think if you put the different dynamics that just talked about, the importance of the role of technology, the scope of the outcomes that can be created, there's a fundamental belief in our firm that if tech is now essentially rebuilding core parts of society, then these outcomes can only be great investments, or can only compound as our investments if they're on the right side of history, if they're also having positive impact on society. That's why our mission is to invest in positive, powerful change that endures. And so, what we're trying to do is to redefine the role of venture capital in society, and while maintaining early stage at our core. Because fundamentally, we're an innovation platform. We call ourselves as a responsible innovation platform. And so what that means is, how do we help companies if they're going to go from inception to billions of dollars in revenue and have an interplay with technology, policy, and capital along the way, and impact lives at such great scale versus pure tech companies? How do we rethink governance? What are the people that we have to have around the table to even help these companies go through those different phases? I mean, that's why you've seen us, Ken Chenault, who's our chairman, he's lived through, running American Express for 20 years, which had 5 different lives, over the 150 years that it's been around. Like, what does it take to endure? We had Ken Frazier join recently. We've been trying to bring people in that can bring that perspective into the firm, so that we can be thoughtful partners to the founders. And the other thing is, the needs of these companies are changing. And so how does the capital structure itself have to innovate to be able to provide that? So, if you look at our work in healthcare, we're basically saying, boy, we don't want to not only do we want to help create this transformation, we want to do it in a way that it's resilient and can stand the test of time for the next 100 years. One of the tenets that comes out of that is, we often debate, success for us would be to have invested in or helped create a company that became $1 trillion company, or the success for us is to help create $1 trillion ecosystem that is following the principles of health assurance. And if it's the latter, then what is the capital structures required, and how do we really support these companies to get there and focus them and help them sort of collaborate with each other? So like that's the next level of thinking that frankly we're figuring out as we go along as well, as our industry matures and as our role becomes more pronounced in these industries.
Well, speaking of just size, I mean, we've billions and trillions. I'd love to talk about, also how you're thinking about the public versus the private markets. And, we just spoke about the private markets. There's this huge amount of capital, both from VCs, hedge funds, everyone coming into the space. The public markets, I mean, have been changing a lot over the last year or so. You were a key investor in Airbnb. I mean, that IPO we saw, it was sort of, I remember that like jaw-dropping moment of Brian Chesky as he watched like the stock going up and up. It was sort of got to wild levels, and they've have been a huge success in the public markets. The public markets this year obviously have been incredibly shaky, and they're changing so rapidly. Where do you see the public and private markets going? And just one other backdrop to that, as you talk about the size of companies you're creating, whether or not that's your pure goal. I mean, take Stripe for example. You were a very early investor in Stripe. I think, correct me if I'm wrong, but you came in the Series B. It was around $100 million. Most recently, it raised money in the private markets at $100 billion, which is like unfathomable before. It's a historic fundraise. Whenever it goes public, it seems pretty likely to be the biggest company ever. So anyway, I mean, just that alone kind of shows us the difference that you could be $100 billion company and raise money and still have potentially even a runway in the private markets before you even get to the public markets.
Yeah, look
here, what are you seeing?
We watched Stripe become what it is since our investment in 2010, and it's actually, frankly, influenced a lot of our own thinking about the size of these outcomes. And what did I know helping a company that's at that scale? 10 years ago when we invested in that company, we didn't know these companies are going to be so large. So I think that's part of what's forcing us to think about growing up. To your comment about public markets are the great equalizer, right? I mean, it's sort of bringing rationale back into the market. If you look at Zoom, there's probably no company that got built king-made more than Zoom because of the pandemic. And today it's trading at, I may get this wrong, but it's 10 to 12 times revenue, which is kind of where companies in the end sort of end up. And so there's been a significant market correction, which I think was needed. I believe, just like it's happened in the past, it's typically 6 to 12 months before that discipline then starts to show up in the private markets. I think what you're seeing right now is the private markets are slowing down a little bit, at least. Last year's pace was just torrid. It was just unsustainable, frankly. But I do think the pricing rationale will become more normalized in the private markets too. But just remember, so much capital has been raised and so many new funds have been created. And the long-term secular belief on these companies is that there's many massive companies to build, to the sort of overarching thesis of unscale that we talked about. So private market investors that are generally hopeful by nature are willing to pay years ahead. So, it just takes time before that correction does manifest itself. And I mean, I worry about a bunch of companies that probably have just enough runway to be complacent, not change their behaviors, and keep sort of building the businesses with the same cadence when the capital was super abundant and super cheap. And I do think everybody needs to become a little bit more financially rigorous in how we build these companies.
But even in terms of this correction, do you see it potentially happening? I mean, you pointed to a few things. I mean, number one, the abundance of capital. Even if it's slowing down, there's still all this dry powder that people need to invest. Talk about public markets as a great equalizer. inflated valuations in the private markets. I mean, do you think there's going to be a reckoning this year potentially with, these high valuations needing to figure out what's next?
So I think the reason there's a lag that if it happens this year, it's probably second half of this year, and the reason is because you look at your public holdings today, compare it to 6 months ago, and they're down for everybody, right? 30 to 50%. You see your private holdings, they're all appreciating because things are still getting marked up. And so there's like this huge discontinuity. But until you feel it in the mark to markets of your private books, the psyche doesn't really change, because you're like, oh yeah, that stuff got corrected, but this stuff is actually going to be amazing, right? Or at least and private investors are very hopeful by nature. So I think that's why it takes a little bit of time. But I sure hope that that happens in sometime this year, because we'll just be more disciplined in the quality of the companies we build if we got there. Because when capital is abundant, you start taking shortcuts, you become loose, you try to do too many things at the same time, and boy, I mean, it's it's all over the ecosystem right now. That's not any specific company, but everybody's behaving that way right now.
Mm-hmm. Beyond just this year, I mean, you've spoken a lot about these 30, you mentioned this earlier, and you've written and spoken about 30-year cycles. Could you talk about, I guess, first of all, can you just tell us what that means to you, and where are we on this? Yeah.
So look, I've said in the past, this digital transformation cycle really started in 2007, right? When we started with the iPhone, AWS, and Facebook started having a digital society essentially, and we've done a lot of work in media, which probably needs to be rebuilt. I actually think one of the trends I didn't talk about that's moving faster than I thought was the crypto Web3 trend. Why? Because there's so much frustration with the way the centralized platforms got built, that decentralization movement is sort of taking hold much faster, right? But that's when that whole thing started. But we have barely moved healthcare into the cloud. We've barely moved IoT into the cloud, right? We're starting to see early beginnings with companies like Samsara there. And education got accelerated, but has a long way to go. So like all the major sectors, they still have to go through significant amount of change when you think about truly leveraging technology and AI in creating those highly personalized experiences. That work is not going to finish in the next few years. I think we're probably halfway through, as best as I can see it, because your latter years, your acceleration of impact does happen, but I know there's 10 more years of really interesting stuff to do in healthcare. So I think innovation being in parallel across many of these industries, and also then many of these technologies, whether it's AR, VR, all the meta movement and what's happening there, and then crypto and biology tools, this is the golden age. It's never happened that you have so many industries changing at the same time and so many new technologies taking hold with significant consequence to their deployment. All the more reason to be intentional in this era.
And when you say that specifically, I mean, baked into this, I mean, this is just clear with what you're saying, but I mean, with that huge in this decade plus we have left, if your theory plays out, is that there's huge companies to be created and huge disruptions of each one of these sectors, or the sectors themselves disrupt everything else.
Yeah. By the way, just one thing, first of all, that's right. There are huge companies to be created, but here we do indict the word disruption a little bit because, after all, if you look at the healthcare ecosystem and that workforce and how they put their lives on the line for us the last couple of years, are we really building stuff to disrupt them? I mean, is that our mindset? I mean, our whole approach has been to say, let's have this mindset of radical collaboration. We can bring, I always say, as technologists, we bring a lot of ignorance and imagination to these sectors, but the leaders and the companies in these sectors are the ones who have lived it and and things are the way they are for a reason. And so I think sort of creating that interdisciplinary thinking and collaborating towards building the future is a better way to think about it. I've written about this before. This move fast and break things and disrupt. I mean, that's a great engineering design principle, but it's not a great societal design principle, and that's not how we should think about it. I think our mindset really needs to be one of radical collaboration.
And it's interesting. I mean, when you let's just speak of healthcare now. It's a nice segue into that. If you've looked, I mean, it's been in one of the slower to innovate sectors. There's regulations, there's good reasons for it, there's not great reason, and there's frustrations as just a consumer for it. But to your point of disruption, it seems like there were a lot of companies early on that said, tech is going to, make everything better, change the whole industry. You just can't. Healthcare is one of those sectors you can't do that. There's too much government regulation around that. And I mean, I'll just say, and I'd love you to speak to this a little bit more in terms of a prediction, but what I've noticed is covering Livongo, and maybe I'll let you give it just your short thesis, or what the company was, what it did, because you'll be able to articulate that much better than I can. But basically, what you did, as you said, was radical collaboration, making it better. Diabetes patients suddenly had this really amazing technology they could use. You did data understanding their, in a broad way, people with diabetes, making their healthcare better, saving money for insurers. I'll just say at the time when I was writing about the company before it went public, there were almost no comps. I was just trying to look at, how will this be valued? How's the market thinking about it? And there was really all the comps weren't good comps. And obviously you went out, I think, at $4 billion, sold a year later, $18 billion. And it was just an incredible run, just as investors. I mean, it seemed like it changed the lives of a lot of patients in a big way. But anyway, a long-winded question, a long-winded statement, but two things there. Would love to hear a little bit more about Livongo. But now it just seems like there's tons of, you showed that this business model that can help patients, a clinical side of things with some tech, radical collaboration. Where is this going now? Is that this business model there? Are we going to see a lot more companies with digitally targeting diseases specifically? What are your predictions?
Yeah, absolutely. So look, Livongo shaped a lot of our health assurance thinking, which is our core thesis that we present in On Healthcare. And the way the company and its culture got built was, Glenn Tolman, who's, multi-time winner in healthcare. I had him come to the Valley, met with a bunch of founders in tech. And I was like, hey, what do you think? Tech is now doing healthcare. And he was very polite. And he said, none of these are going to work. I was like, exactly. Come do one with us. Let's build a truly interdisciplinary culture, which is not tech first or healthcare first, but is at the intersection. And let's do what's best for these 32 million consumers that have diabetes, including his son. And so what we ended up basically doing was build an experience that keeps people healthy, so proactive care, have a true commitment that we will do it in a way that us and companies that build with the same intentionality will take out 100 of the $350 billion cost every year in managing diabetes and its comorbidities, and do it in a way that we can actually offer to all the stakeholders. That became health assurance. Why? Because we're like, oh boy, we can actually create an experience that consumers love, just like they love their tech companies. We can roll it out to about 1 million people in a span of 5 or 6 years. So there's scalability, and we can build a business with unit economics of a tech SaaS company. Well, this is existence proof. How about we apply this mindset to all of healthcare? I think that's sort of what the thing I'm most proud of in the Livongo story is actually not the size of the outcome, but the fact that this became a playbook that many others follow. So, and the number of plans we got that were Livongo for X being another stakeholder or comorbidity or disease state, whatever it might be. And so it sort of unleashed a belief that you could actually build these kinds of companies. And I really think that plus the pandemic happening just catalyzed this perfect storm. And we basically said, hey, we serendipitously got put in this place where we can make a difference here. We have a playbook. We understand culturally how to build businesses that align. And at that time, a lot of the institutions and health systems were trying to come to us to say, hey, how do we think about our digital transformations? We're like, hey, we have folks that want to collaborate with us. And so that led to us literally mapping out and saying, here's what a modern health assurance system needs to look like in the next 10 years. And let's go, help existing institutions play their role in this, and also help create new companies and invest in new companies that all need to exist as one ecosystem to go make a difference. Because we don't want a 20% of GDP healthcare system. We want to reduce it, right? That's not where we want consumers spending their dollars. Right? You just want to be healthy. Mm-hmm. And so, that intentionality and that collaboration with the stakeholders in the health systems has been amazing for us. It's shaped, our thinking when we think about new industries now. It's like, well, what is that end game and the core principles that will allow these companies to be long-term compounders and enduring in society? And let's go build towards that, right? And that's a little bit of what's become, a core focus of ours.
And so that's in healthcare. And so let's talk about one other big area. We talked about Stripe specifically, which is just a giant in the field, but fintech seems like it's going through just there's so many companies that seem like they overnight have become these huge companies. Where's fintech now, financial technology, and where is it going?
It's interesting. Fintech probably has, we have a very large portfolio in what we call fintech. I mean, thanks to a lot of great work by my partners, Adam, Alex, Kyle. There's several people in the firm working on this. And we've actually built great businesses, as an industry in that area. I mean, I think Stripe will, all odds are, by the end of this decade, it'll be $1 trillion company, right? And I mean, who would have thought? It just boggles my mind to think about it. And that's one of several that have an opportunity to be, hundreds of billions or that scale. And so, but I think all of what fintech has done so far has been taking the efficiency out of this system, sort of, making things more streamlined. But when I think about the same set of principles for organizing capital on the internet, like organizing care, what do we really need? We don't just want, a consumer to have less fees if they're less affluent, which, there's amazing banks like Chime and others that have come about and are, serving different segments of consumers. The role of organizing capital on the internet is to actually create abundant opportunity. Internet turns scarcity into abundance, is the Peter Diamandis thesis, right? We need to turn opportunity from scarcity to abundance in fintech. And I don't think that has really been done yet. And a lot of thought needs to be given to that, this convergence of DeFi and crypto and the centralized finance that exists today and how that ought to play out, to create that opportunity. So we're giving a lot of thought, and we actually call this Finclusion, by the way. This is our sort of internal nomenclature for this, to think about how do we be a lot more intentional in that area as well, because again, that's a massive, massive sector where a lot of value can be created.
Well, I mean, that gets us, I think, to the book. The title of your book, as you said, is Unintended Consequences. And when you think of areas of all of what we're talking about, but I think particularly fintech, crypto, the velocity of change is just sort of unimaginable, as we've talked about, even like a couple of years ago, just how quickly things are moving. So your book, you have a thesis of thinking from the very early days about the consequences and putting systems in place to create that you don't have these unintended consequences. Some of the scary things we've seen in tech in recent years. Can you walk me through that thesis?
Yeah. So this framework, obviously, we call it responsible innovation. To us, it's really three things. One is sort of intentionality with which we build these companies, right? Being mindful of the change we're creating, the unintended consequences that could emerge. Look, they're called unintended for a reason, but by having the right set of mindset and mechanisms in how we build these companies, I think we can minimize that. That's really the point when we sort of wrote the book. The second is inclusivity. We just have to build these companies while thinking about all the stakeholders, not just your investor, employee, and your direct customer. There are consequences as you dislocate value in workforce and consumers that you don't serve and society as a whole. And how do we think about everybody and measure what we call with key consequence indicators, those second and third order effects. And the last is impact. And I think this. We're very much capitalists at heart. So this is not meant to be a do-gooder statement at all. This is a deep belief that if the role of tech is so pronounced in this next phase, that we're building our core institutions, rebuilding them with tech, then the best investments, which are the ones that compound for a long, long time, will only compound because society allows them to, which means they're actually positive for society. So there's a false choice between impact and financial return. And so that alignment is very, very important in how we think about these businesses. So I think that's kind of the overarching perspective. And what it really means is in this next phase, in order to be a high performance investment firm, you have to be a high performance impact firm. And that's when I said we're trying to think about redefining the role of VC in society. That's really what foundationally what that means. So the team, through our entire ethos, team, products, the way we think about governance, the way we think about tackling industries and transformation, it's all governed by these set of principles. We even, I think you may have seen, we announced Responsible Innovation Labs, which we started with two of our colleagues from Stripe to say, hey, we don't have all the answers. We have a framework. Can we, start to create a little movement in the industry, and let's all come together and figure out what these principles are that we can then be using in the way we build these companies that we're building. So, it's we're deep believers that this has to be core to our work and core to our success in the future.
So in the future, I mean, even if I agree with your thesis that these companies in the future can put all of that together and be the enduring companies, might be the ones that are also have responsibly innovate. I mean, right now we are living through a moment and seeing it very firsthand. And I'll say, we'll take Facebook for example. And in your book, you mentioned that you'd rather not wake up as Roger McNamee and have one of your best investments be Facebook, which there's just been many questions around its role in democracy and elections, and I could go on and on. But if you look at it, if you're an investor in Facebook, I mean, it's been one of the most incredible in the private markets or public markets, an incredible investment. It's hard to imagine it's not an enduring company. It's getting close to $1 trillion. It's had some of the worst headlines over the last year. So many revelations from insiders, including my former colleagues at the Wall Street Journal, wrote some incredible stories last year. But all that said, even with that, the stock dipped, but I was just looking yesterday, it's still up about 20% year over year in a pretty tough market. So how do you control for that? Because there's, if you... Look,
first thing, this is I think a lot about this. The very first thing is, even Facebook, it's not like the team that started that company intentionally went down this path. This is the example of unintended consequences, right? Because you build a community, you don't think about all the stakeholders, you get on the shareholder obligation, which forces you to think about growth. And if echo chambers drive the growth, then you create echo chambers, right? I mean, that's sort of how it happens, as opposed to there's some malicious behavior from the beginning that drove it. And there's lots of great people sitting in there to trying to fix it, because once you create that kind of a flywheel, it's hard to unwind it. So first thing is, how do we build these companies so that does not happen, so that you get the goods and you can minimize the unrest that it creates. And there's got to be a way, and I think that's what we try to explore in this book, to say what are those frameworks that can help us get there. Second thing I would say is, yes, in the short term it looks great, but if you think about all the stakeholders, huge amount of talent drain, people are leaving, they're exhausted, and some of them have tried for a long time, for example. Will it really survive? Time will tell. Will it actually, because we are long-term sort of in our perspective of sort of these companies. It's not about, Facebook's a young company, right? And so, how will it really end up? I think TBD. But for my own conscience, I can tell you, what this is an individual comment. I've had a pretty good run. Everybody in this industry has become very successful financially, and so have we. And going from very successful financially to very successful financially plus a company like Facebook will be a terrible way to retire, right? So I am definitely afraid of that, and that doesn't mean you will not take a shot at helping build technologies that could go right or wrong, because technology generally is neutral. That just means we got to be a lot more intentional in how we shape where those technologies and companies go, and we can do something about it, as an entire diaspora. And I think that's really the point of why we highlight that, and why we're trying to say, let's rather than have this ESG mindset, which to me is trying to control from the outputs to build a environmental and sustainable company. Let's have responsible innovation inputs from the beginning, because so much of the economy is getting rebuilt, and let's just get it to be on the right side of history with the right mindset and mechanisms from the beginning.
One of those mechanisms I want to ask you about is, Mark Zuckerberg really, he wasn't the first to do it, but he was, one of the early people to sort of bring it to the public markets, was this founder control. And, he has, whatever happens to Facebook, I mean, it seems like he has unlimited control of the company based on his voting shares. And what I've seen, and I mean, I want to hear your perspective on this, is that I think it felt like there was more pushback years ago, on these 10-to-1 votes, 20-to-1, 100-to-1. And it seems like right now, we talked about the abundance of capital earlier. There's almost none. It's really everyone I talk to both in the private and public market say, what can you do? You're just going to miss out on companies because everyone's getting it. But as a VC from your seat, and even if a director, once you let founders have this control, what control do you have? And so how are you thinking about that right now, especially in this climate?
It's a big issue. And, I think it power corrupts. And I think for a lot of businesses, this doesn't matter, but when it matters, it's very problematic to have so much power over one person. So I do think it's a place where our ecosystem can be a lot more rigorous and consistent, and sort of, it's game theory, right? Everybody has to behave this way, is the only way it's going to happen, and make this one of the non-negotiable things. We're not there. And I do sure hope that as markets normalize more, because right now, with the abundance of capital, founders have a lot of leverage, that this can swing back towards being more responsible. I mean, I would love for you to talk about, I mean, you wrote a book on this with the cult of we, and you talked about the startup delusion. I mean, you've seen this happen, right? And like, what did you learn studying WeWork deeply, and sort of what are some generalized observations from there in this regard as well? Because I do think this is a place where we have to create more accountability for the founders as these companies grow up and become more prominent. It's okay in the early years, but it becomes very problematic as these companies scale. So I don't know, Maureen, like maybe we could just talk through your perspectives and your learnings there.
Sure. So founder control and this whole climate and backdrop did feel like it catalyzed a lot of the really bad behavior, frankly, at WeWork. So, Adam Newman had this good idea. He sort of sold it. He convinced a lot of people that this real estate company was a tech company and should be valued like this. He was a masterful fundraiser. He was able to, just do a lot of great things as a visionary founder, but there were, problematic issues that it was never profitable, and he never fulfilled any of the things on a financial level that he promised. But every step of the way, I mean, just when you talk about intended consequences, unintended, he was the poster child for a lot of, sort of the worst of founder control. It was like from day and this abundance of capital chasing a founder like him that was going to change the world and build a huge company. And we saw it from early on. And I think even at the time that he was building his company, and tell me what you think on this, Hemant, but like people were not taking that much capital out. And he was selling shares in almost every round. Eventually, it got to a point where he was borrowing hundreds of millions of dollars with the backing of JP Morgan and other banks, giving him huge loans. He was spending tons of money. He got a $65 million private jet. And I mean, one of the big things, so Adam pushed the limits in every way and in ways that were detrimental to the future of the company. And obviously, once that S1 came out right before the company went public, it sort of, the whole company crumbled, or like the faith in the company crumbled. But all that said, it's like he did a lot of wild things, but he had this founder control. He had so many people clamoring to get access to the business in terms of providing him with capital that it felt like he held all the power. And one of the things I think we saw that kind of floored us every step of the way writing the book was just like what the board of directors didn't do, and other stakeholders, whether it was bankers or investors. There's a lot of grumbling and red flags and frustration, but every step away, people went along with it until you talk about IPOs in the public markets as the great equalizers. And they certainly were. It was like, that was the first time anyone had pushed back on Adam Newman, was when right, like at the moment before the IPO, and it was clear that public markets weren't going to accept it.
Yeah, look, I think this is an example of where, as you were talking, I'm like, boy, if you had sort of a responsible innovation mindset and governance from the beginning, you would be thinking about, all the stakeholders and everything that's going on in the company versus just growth. In this case, for example, people are obsessed with the fact that a profit will come. It will just keep pouring money, keep growing, and so you just fundamentally. I mean, the idea is actually kind of great, right? I mean, and fundamentally could have been changed the world outcome, but it didn't. I think company building might have had to do with the actual outcome versus the idea itself. And one of the things we can do better at, and I've learned this from Ken Chenault a lot. It's like you don't build leadership and followership with control. It's sort of you want your team to sort of believe in you and follow you because of your actions as opposed to because you have control. And I think that's like, how do you really ingrain that from the beginning in our companies as well? So frankly, a place where we can all focus more and do better too. I think it's one of the places where the obsession is so much about growth and markups and sort of the short-term sort of validation that we lose sight of the fact that oftentimes that becomes inconsistent with what's going to win in the long term.
Mm-hmm. One thing there, and in terms of the frameworks you're setting out, I think it's a great point. The thing with I think Silicon Valley right now, and with what Adam Newman did, I mean, you talked about ESG and that it can be like focusing on outputs. It doesn't really do what it sets out to do. But I'll just say this, Adam, yes, it was all about growth. It was all about valuation for so long, but he also was absolutely brilliant in just talking, making it so mission driven. And, he would talk about it's we over me, and we're going to change the world. How do you make that? And he convinced a lot of people. They're amazing employees who we got to know over the course of writing the book, who were really, I think that's maybe one of the biggest tragedies of WeWork. It was like that all these like young idealistic employees came in and really believed what he was saying. Like, we're going to have like capitalism and we're going to change the world, and it rocked their worlds to see how it played out. But how do you make it real, and how do you hold people to it? Because if you listen to him, it was doing all the things you said, but it really wasn't.
Yeah, so I think the question is, what are you measuring in that context?
Yeah.
Right. And so, look, you need an inspirational leader to attract capital and attract talent, and go through the hurdles because building a startup is really hard. So I actually think that's a very necessary skill set. But what are you measuring on the other side in terms of the quality of the business you're building? And that's where the governance comes in to say, are you really understanding, first, second, third order effects, and in this case, even sort of the fundamental metrics, right? Like this was even financially sort of, is the business going to be robust or not? And do you really believe that, or is capital just going to hide a lot of those sort of fundamental issues that maybe the business was never going to work? So it's more complex, I suppose, is what I'm saying. But the more we can be measuring not only financial, but also these sort of, impact metrics, as I call them, the more you're going to have an understanding of the business and its resiliency over time.
Do you put them out there? Like, who holds the board, who holds the founders accountable?
Look, we're figuring this out. I mean, in a lot of our healthcare companies, have a regular dialogue with the founders on, okay, what do we do to shrink the pie? How our business grew, but did we make healthcare more unaffordable as a result, or did we actually shrink the pie? Because otherwise, what impact are we having? It's not going to be a business that's going to subsist if the system as a whole is just going to bankrupt us. It's not a business. So I think every industry, every business, those metrics are different. The key is to start having that dialogue now and sort of bringing it into our ethos and getting better at it. We speak a lot about this internally. We don't have all the answers. I mean, that's one reason we helped coalesce the Responsible Innovation Labs, is so everybody can put their heads together and we figure this out. But there's got to be, we have all these playbooks for how to do optimal growth, maximize growth. Where are the playbooks for thinking through these things? We need those playbooks, and we got to adopt them. And so I think that's a little bit of what we're trying to catalyze internally, and then sort of collaborate with others to build some good frameworks.
So I know I'm looking at the time right now. I know we only have a few minutes. There's so many more things we wanted to get to over the course of this hour. So I'm really enjoyed every piece of this conversation. Is there anything else you think we should just touch on before we wrap up that we have not yet?
Yeah, I mean, look, I would say, we're sort of an interesting moment in time, and everybody that's building their careers and going to go do this for a long time as investors, the more we can adopt this mindset in the kinds of projects we get involved in, and the more intentional we can be in how we bring technology to life versus the more indexing we do, frankly, the better, because you don't want to put capital behind every idea, because some of them actually may not be the ones that are going to be on the right side of history. So I think just being intentional, being more sort of long-term oriented, versus sort of playing index trends is one place where I would encourage the whole diaspora to be thinking about, because it's the consequences around how technology gets brought to life in all these sectors is still very unknown. We don't fully understand it, and so I think we shouldn't just fund every single idea, and but that's the approach we're taking at GC. And our view is, our game is to bring this responsible innovation mindset into this industry, and we're not competing with anybody, and hopefully everybody can start adopting that type of mindset in helping new and hopefully productive ideas to life.
Well, that's great. Well, one thing I want to just say before, as we're as a parting thought, is I love what you've said. I really like all the ideas in terms of responsible innovation, but especially what you just said in terms of the playbook for growth. You've done an incredible job at growing these huge companies. You know how to scale. These questions are ones that you'll be wrestling with, and everyone, I think, in your ecosystem, hopefully. But I would just love to have, maybe this time next year, whenever it is, to just keep this conversation going, and kind of looking forward to seeing what you're learning along the way, and in all different ways with this responsible innovation.
Absolutely. We have to make forward progress. So thank you, Maureen. That was a great conversation.
Thank you so much.
Yeah.
Thank you both. And a reminder to those who joined us today, thank you for your time, and also check out the 2 books that are in the link, and hopefully we'll see you on February 28th for our conversation on health assurance. But thanks, Maureen. Thanks, Hemant. And thanks, everyone.
All right.
Bye.
Thank you.